Hello, I am Daniele from Zeygos, and today I will share with you an analysis of the financial markets prepared by our research department. If you find value in our content, I invite you to subscribe to our channel. Pre-opening commentary. The refinancing risk. Before delving into today's topic, I would like to say a few more words about the China situation. In today's session, we are witnessing more sustained buying activity, following authorities' call for operators to exercise patience and allow the measures implemented over the weekend to take effect in the market. Certainly, these measures will yield their effects. Equally certain, however, is that these measures will not prove sufficient. This is the consensus among analysts and strategists who believe that the authorities, the government and PBOC, need to do more, implementing a bazooka similar to the one used in 2008. Without such action, this rally is poised to fade, rendering the adopted measures entirely ineffective. The issue is that there is consensus among operators that such extraordinary measures will not be adopted. A recent survey conducted by MLIB Pulse among 455 managers and operators highlights that 57% of them believe that Chinese authorities will limit themselves to implementing mild, non-aggressive measures. And this is not beneficial for the market. In yesterday's session, Chinese authorities reportedly even requested fund managers not to engage in net sales of their funds. They could sell shares only if there are other purchases to offset the outflows. This is yet another measure aimed at limiting pressure and defending a stock market that experiences significant selling flows from foreign managers every week. But now let's turn to today's topic, the refinancing risk, which refers to the risk associated with the obligation of governments, companies, and individuals to refinance maturing debt at higher rates due to new market conditions. This risk is closely tied to the restrictive monetary policies of central banks but exhibits a time lag. When central banks raise rates, these increases do not immediately translate into higher debt costs for businesses and households. On average, such costs tend to rise over time, as maturing debts come due and need to be renewed. It's only then that the refinancing risk materializes and generates its adverse effects. Understanding this dynamic is of fundamental importance because it allows us to grasp when the effects of restrictive monetary policies will concretely materialize. These timing factors depend on the debt maturity schedules for companies, the terms under which households contracted their debts, and the structure of government debt, fixed or variable. Let's start with the refinancing risk for the corporate world. Based on the currently available data, the majority of existing debts that were incurred during the 2020 to 2021 pandemic crisis will mature in 2025 to 2026. It will be during this period that companies will have to contend with higher borrowing costs. And the magnitudes are not negligible. We are talking about $430 billion in refinancing debt. Yet, this refinancing process will not be painless. Some companies will find themselves in difficulty. The increased financial burdens will not be covered by the company's cash flow, resulting in a rise in insolvencies and failures. Moody's Investor Service predicts that the global default rate for high-yield companies will surpass the historical average by the end of this year, reaching a peak of 4.7% in March 2024. For Europe, the peak is projected at 3.8% by mid-next year. The companies that overcome this challenge will still find themselves having to make choices. They will need to reduce investments and may need to downsize their workforce, all of which comes at the expense of growth and employment levels. Translated, the refinancing risk leads to a macroeconomic slowdown. This is clearly stated and easily understandable. In the UK, the refinancing risk for companies is very real. A recent study by the Bank of England, BO, reveals that highly leveraged companies account for 60% of corporate debt but hold only 5% of the total cash among all companies. This implies that such companies will inevitably be forced to cut investments and lay off many employees, and this will happen soon. The losers among companies in the next 2 to 3 years will be those with high leverage and narrow profit margins. Among them, companies in the construction and automotive sectors are at significant risk. But is the refinancing risk temporary or will it persist for a long time? Judging by the shape of the swap curves, it seems that this risk will endure for quite a while. Another question. What is the amount of this risk? What is the average refinancing cost? The answer can be easily identified in the trend of the graph below, which illustrates the economic advantage or disadvantage of refinancing debt. Just a year ago, refinancing debt was an advantageous procedure as it saved around 150 basis points on the debt cost. Now, however, this procedure is much more costly. It implies an additional debt cost of 150 basis points. In practice, for many companies, the gap is 300 basis points. Imagine a company that in 2020 had planned its business relying on the possibility of refinancing existing debt at 150 basis points, and after 2 years, it finds itself in a completely different scenario where the refinancing cost is negative. In effect, the additional cost, compared to forecasts, is 300 basis points, and for many companies, 300 basis points is a significant increase. Some companies operate with profit margins of 5 to 7%, and they are not few. However, the issue of refinancing cost is not just a corporate problem. It weighs and will continue to weigh on household budgets. Its impact depends on the dynamics of the mortgage market and households' tendency to finance at fixed or variable rates. For instance, in the UK, the mortgage market is highly dynamic. It allows a borrower to continually change the terms of their debt, thus always choosing the optimal conditions. For this reason, despite the elevated interest rates in Britain, the cost of 2-year mortgages is 6.7%, the average interest paid by British households currently stands at 3%. This is because many families, guided by their mortgage advisors, have switched from variable rate to fixed rate mortgages, at least for a few years. It's very difficult to renegotiate for more than 5 years. Opposite situation in Italy, where there's a clear conflict of interest at play, no offense to our banking clients. In Italy, mortgage consultation is provided by the same bank that issues the mortgage, which naturally avoids contacting the client and recommending a switch from a variable rate to a fixed rate in a context of potential interest rate increases. Indeed, with the numbers at hand, in Italy, a significant 40.9% of mortgages are at variable rates. Only Portugal and Finland fare worse. So, what does this mean? It means that the impact in terms of erosion of households' purchasing power will be more pronounced in Italy and Portugal. This impact translates into, on the one hand, a contraction of aggregate demand in these respective countries, and on the other hand, a point not to be overlooked by those invested in Italian banks, an increase in the risk of insolvency, non-performing loans, and their related effects on the profitability and solidity of banks. And what about governments? The refinancing risk affects them too. Fitch has calculated that the recent trend of rising interest rates globally results in an increase in debt costs by $2.3 trillion, on average, meaning a 50% rise in interest expenses compared to the average levels of 2020. For countries like the UK, where 25% of the debt is linked to inflation, this context is even more painful. In such a scenario, many local authorities and municipalities in the UK are postponing debt issuance, waiting for better times and hoping for a decrease in rates in the future. But will it really happen that way? Based on current market pricing, the reality is quite different. The markets are factoring in elevated rates for a long period. This amplifies the refinancing risk even further. For more information, visit the website www.zeygosonline.com, or if you'd like to receive our services for a 1-month free trial, please write to info@zeygos.com. Zeygos exclusively provides informational and analytical services on financial markets and does not engage in any form of personalized investment advisory activity.